You know, what makes stocks go up is, surprisingly high gross margins 6 months from now, right? Like, in the end of the day, that's probably the number one thing I want to know is, like, do I have a differentiated view from consensus on, profit margins 6 months from now? And there's some wacky stuff going on with, inflation and what you're paying for stuff and what you're charging for stuff. And I think it's going to cause a lot of stock volatility. I just noticed that margins for staples are at all-time lows and probably have some, potential abatement of headwinds and maybe even tailwinds on the cost side. So that's a sector that looks optically expensive in some cases that I kind of like more than I used to. So that was kind of what we wrote about a little bit today. And on the flip side, I think some of the industrials companies probably have more margin headwinds than people think, and are probably overly optimistic on the estimate front. So we're sort of saying we like staples more than industrials as a result of that work. But definitely people are trying to figure out margins.
Do you think positioning is going to be a huge story in the back half as people try to get at least some credit for a rally that they might have missed?
Yeah, it's a good question. I never know how to totally answer that because the multi-strats are so big now and they run at such huge gross exposure that, you're used to thinking, a $100 billion account like that asset manager, that's really big and they're going to matter. And if they have a couple % cash on the sidelines, it matters. But when there's a multi-strat running $80 billion at 900 gross and it takes the gross to 1,200, it's just, and they trade 500% a year instead of 30%, the impact on volume is it's 10, 15, 20-fold. So it really just depends on whether the big multi-strats see an opportunity to spread out winners from losers in the second half of the year. That probably matters more than the cash on the sidelines. And when I look at the data from the big firms on that I have access to, you could get people with bigger net exposures. You could see grosses go up and nets go up. So it's possible you get a bigger positioning fueled rally.
Are they underexposed to equities right now?
I think when you look at the hedge fund data, it shows like bottom quintile on nets versus the last 10 years. So certainly people could take it up more. I don't know a lot of people who have pro rata participated in this rally.
No.
I mean, there's not a lot of bottom up traditional stock picking hedge funds that are up 15 or 20 this year.
I know. So is that a bullish sign then as they start to capitulate?
I guess if I'm being cynical and, I worry that people pile in at the exact time when, so are we at the peak? I don't think so. I think you get more, exposure up before, you get the sell off. But I don't agree, you guys were chatting earlier, I don't agree earnings can collapse at the way some of the bigger firms are articulating. I think that's very unlikely. Actually, I thought of something on the air with you guys about a year ago, which you'll remember. I said, I don't know if 2024 earnings are above 2023.
Right.
And you remember we talked about that a couple times.
Yep. Yeah.
And I'm not sure I've changed my view. I think the idea they collapse this year and V-shaped recovery next year is just not the consensus view at all. And I don't think investors think earnings are going to be well below $200 because if you already take what you had in the first quarter, you're embedding one of the bigger collapses ever to get down there, and there's too many reasons why that seems unlikely to me. Weakening dollar for the multinationals, low-end consumer holding up, auto saw.
But it gets back to your first question.
Cycle,
there's a conventional wisdom that as CPI comes down, that's going to hurt margins. That these companies have just done so well because of the pricing power and the inflation.
Yeah, I think it's a combination of their input costs and what they could sell it at, right? And if your input costs are generally materials, labor, and depreciation. That's generally the things that drive your cost of goods sold. And so which one of those things look like they're incrementally getting worse? Not really any of them. So, some of the companies are showing okay pricing power still, or they have work in process, they're going to ship out at agreed upon price. So I think it's unlikely earnings collapse this year. And I don't think they'll V-shaped recovery next year unless you think there's a big fiscal stimulus and you want to kind of position your portfolio for that. And I don't think that's the base case either. So I'm hearing a few, I do a lot of meetings too. I guess we all do, and that's our job. I have a company, and for a living, I try to do meetings to get paid for them. I'm not hearing anybody think the base case is earnings collapsing that much. And I think part of the reason the market's up this year is actually because the probability of the bear case is lower than it was 6 months ago, and the severity of a bear case is if it formed is lower than it was 6 months ago. I think that statistical expectation, that's part of the reason the market's up.